Hello, and thank you for watching the Pure Passion Biz Podcast with Akua Hinds. I am your host, Akua Hinds. And today I have the pleasure of interviewing Andrew Mahorn. Andrew is the owner and director of LNM Accounting Solutions based in Kitchener, Ontario, in Canada. He has been working in this capacity for the past 7 years, and he mainly focuses on small businesses and working with small business owners. Andrew, thank you so much for appearing on my podcast.
Yeah, thank you for having me. I'm looking forward to it.
Oh, thank you so much. You were most welcome. So, managing the books of a business, it's not a skill set that every entrepreneur has. I'm an entrepreneur as well, and managing the books is just not necessarily my forte. Now, how does your company provide peace of mind and prosperity to entrepreneurs with e-commerce businesses?
Well, uh, we come alongside our clients to really help them and make sure they are educated on their own books and their own processes so that they feel more comfortable. And really, it's not just e-commerce businesses. E-commerce business is a very special class of business that requires a lot more attention because they are pulling data from multiple sources. For example, there's Shopify, there's eBay, multiple sales platforms like Sandcart, um, Thinkific. And so that those sales data needs to be pulled in along with different credit card processors like LCM or Stripe or multiple bank accounts. Multiple banks, they also process credit cards. So that data all needs to be pulled into the accounting software. And then that accounting software will also track other expenses as well. So it's just a matter of pulling all that data into one location to run general reports that can be used to make good business decisions or for management purposes or even for the bank. So e-commerce is special, where it's a matter of pulling a lot of data from multiple sources. So really that's where we come in to help simplify that process and set up the software and the processes in place to basically pull everything into one place so that we can run meaningful reports and then discuss them on a regular basis.
I'm sure that's very useful to your clients because e-commerce business owners can, depending on how they run their business, they can have customers living in their local area who are shopping and live in their area and paying those local taxes. Or they might have customers who are worldwide. And there's all of that to factor in as well. When you said that e-commerce is special, so when we're talking about e-commerce, are you mainly talking about people who have a Shopify store, people who have an Amazon FBA business, or do direct sales business owners also get put into that category too?
Really, anyone selling online can be considered e-commerce. And again, there's so many sales platforms. There's Etsy as well. Uh, yeah, anybody with an online store can be considered e-commerce. And part of the thing that makes it a bit more complicated is that many online sellers will sell across multiple platforms to reach the broadest audience possible. And so it's literally a matter of pulling that data from all those different data sources into one accounting software to run general reports. And sometimes that's also in combination with a brick and mortar store as well, right? And so that's a little bit, I wouldn't say easier to track, but we all have a POS system, in the store. So it's different. But again, it's another source of information that needs to be pulled in.
Thank you so much for shedding light on that. And what is a common misconception that entrepreneurs have about tax write-offs? So, which expenses would people be surprised to know that are not considered to be tax write-offs for all entrepreneurs?
Well, this question can go either way. So, for example, some business owners, especially younger or newer business owners, I need to let them know that, hey, you are operating a business out of your home. So, a part of your home expenses can be considered a business expense. Partially your mortgage interest or your rent, property tax, landscaping, security, insurance, all that is considered a business expense. Or even if you're driving for work, driving to see clients, driving to pick up inventory, things like that, or even delivery, a portion of your vehicle expenses can also be written off as a business expense. Uh, you know, uh, Repairs and maintenance, fuel, insurance, car washes, that kind of thing. And there are some interesting stories that have happened out of that. So, for example, uh, there was a contractor, very great contractor, and he used his own personal home as a show home. And it had his family, his kids in there. And so each room had a completely different decor to show off his skills. And so he literally tried to write off 90% of all of his household expenses because he was using his home as a show home, and it was allowed.
Oh, you're
Or
successful in that.
oh
Wow.
yeah, and so that is a very extreme case that doesn't normally happen. Or on the flip side, another client of mine, he makes music videos, and he literally spent $10,000 on a Rolex and wanted to write that off as a business expense. I did not encourage him to do that. I say, maybe a portion of it can be considered a business, not the whole thing. So little things like that. And then it can get even a bit more tricky depending on your industry. So for example, an actor can spend a couple $100 on a haircut, and that can be considered a business expense. Um,
I see.
but for anybody else in a different industry, maybe not.
Okay, so if you are in the business of modeling and displaying products, using yourself to perform, being a performer, there's
Yeah.
some senses like maybe manicures, pedicures, haircuts, hair colorings
In
that,
those situations, you are the product, technically, right?
right, right.
Yeah.
Very good to know. So why is it that the Rolex wasn't accepted? I mean, if the Rolex was used in the music video, then why wouldn't that be considered a,
Yeah. So and this is CRA's thinking. So me, because I'm the worst in filing, so I didn't feel comfortable using 100% because there's multiple factors. So one, because I've been through a number of audits, and I kind of know what CRA is looking for, what they're going to ask if they see spike in a particular category. So if they see a spike in, meals and entertainment or inventory or something like that, it may cause a red flag, and they'll say, show me what's in that account. And through bookkeeping, I'll send them a list of all the transactions in that account, and they may pick out which ones they want to see paperwork for. And in that situation, it did go that far, because I said, let's only write off a portion rather than the whole thing. They may ask, oh, is that a Rolex? How's that Rolex considered a business expense? And it would be on the client to justify it. So in that situation, I knew that they would say that's not a 100% business expense, and I just decrease. I don't remember what I decreased it to, but just a portion rather than the whole thing. And so really, that Rolex is going to last, say, a lifetime. But if it's only used in one or two music videos, that's not 100% use for business purposes, Yeah.
yeah,
And
sorry.
and, and there, yeah, there are a few others, and really that's only a portion of it. And then on the flip side, sometimes clients can take it a bit too far, like the Rolex. But I think it's important to, and I tell my clients this all the time, you can literally put anything you want on your taxes, literally anything. But I always say, be prepared to prove it in case CRA comes asking. And that's where paperwork is extremely important. Because, if sometimes they may want to see the paperwork, especially when it comes to GST. So that's why a conversation before anything is filed is important, because I want to make sure I feel comfortable filing it. And also that if CRA asks any questions, that I feel comfortable answering those questions as well. Because many times CRA will ask me those questions first, and I'll be able to diffuse the situation or work with CRA without the client even knowing, because I have those answers, I have the paperwork, and I can, go through that audit and then inform the client later. This happened, but everything's okay because we had the paperwork, we put those processes in place, a long time ago. so that if this ever happened, we're okay. So
Mhm.
I just want to make sure that I feel comfortable filing it and have that dialogue with the clients before anything is filed, just so that we are prepared for in the unlikely event that the government comes asking questions.
That is such useful information, and it never really occurred to me, but I think that now based on what you said, using that Rolex as an example, maybe business owners should really talk to their bookkeeper, to their accountant before they just make a purchase, assuming that it's going to be considered
Exactly.
a tax write-off, right?
Yeah, another conversation I like to have is for maybe consultants, real estate agents for particular industries. Um, and this happens very often for younger and newer clients as well, where if they're trying to increase expenses and they're looking for ways to increase their expenses to decrease their taxable profit, um, sometimes it's a matter of spending strategically. So I give this example. If a real estate agent finds that there is a real estate conference in Hawaii,
Right.
sure, you can go, right?
Mhm.
You may not be able to write off 100% of that trip, but a large portion of that trip will be considered a business expense, right? So sometimes it's a matter of spending strategically.
That's a great tip. Thank you. So everybody save your receipts just in case. And speaking of businesses, business ownership, and the type of businesses that are out there, what are advantages and disadvantages of being a sole proprietor?
I always say that it's best to start off as a sole proprietor. There are a number of advantages to that, especially when you're starting out and you know there's going to be losses.
Okay.
So I have a bit of an example. All right. Let's say Wayne works at Willy Wonka's chocolate factory and makes $100,000 a year through regular T4 employment income. That's fine, but then he wants to start a side company, a side hustle called Wayne's Widgets. In the first year, through advertising and through getting himself started, he may lose $20,000 in that business. So within that first year, let's say he still maintains his full-time job. In that first year, he made $100,000 from his normal T4 employment, but then he also lost $20,000 from his side hustle. So when we're doing his taxing, you put that income together, 100 minus 80, sorry, 100 minus 20 is $80,000. But he's already paid income tax on $100,000 through regular deductions through his job. And so in that situation, because he's overpaid in his taxes, he will get a refund for that difference. And so that is part of the advantage of basically taking advantage of the loss when you're a new business owner, right? And then let's say years down the road, Wayne's Widgets are doing much better, where he's now successful enough to quit his full-time job and he's profiting $100,000 from called, let's say, Wayne's Widgets. Um, that's a very different situation. Now he has a whole different set of profits. So he's profiting $100,000 through his sole proprietorship, say Wayne's Widgets, but he only needs $50,000 to live through, let's say, his mortgage, groceries, and insurance, right? But the issue is that because he profited $100,000, he's taxed at the highest level on all that $100,000, even though he only needs 50. So at that point, it is best to incorporate because Wayne can only pay himself what he needs through dividends, which is the lowest tax bracket, but then leave the rest in the company to be taxed at the lower corporate rate. So, and that may be a lot to take in, but the general rule for incorporating and switching from a sole proprietorship to corporation is when you're making or profiting more than you need, then it's time to incorporate. Only pay yourself what you need in dividends and leave the rest of that profit in the corporation to be taxed at the lowest rate. And that's only for tax purposes, but there's a bit more to it, but that's a very simplified situation. But that is a great example of when it's time to incorporate and a bit of the advantages or the discussion between a sole proprietorship and corporation.
Well, thank you so much for sharing that, Andrew. I was going to ask you, what are important factors as well for an entrepreneur to consider when deciding to transition their business from being a sole proprietorship to a corporation? I think you pretty much, shed some light on that. Is there anything else that you want to add?
Yeah, from a tax perspective, that is the most popular avenue people think about when transitioning. But there's also liability. Uh, as a sole proprietor, uh, in the eyes of CRA, the individual and individual sole proprietorship are the same person. And so when it comes to liability, it's the same situation as well. So if a sole proprietorship were to be sued for whatever reason, that individual owner is also being sued and they are also liable. And so with a corporation is a completely separate entity from its owners. And so it provides a layer of liability. Now, again, this is a simplified example. And so I'm in that conversation about how do you recommend speaking to a lawyer. But that's liability is something to consider. And also when dealing with certain vendors or certain industries, being incorporated just gives a more professional air to it, or it is perceived to be more established. In some situations, it is beneficial, but again, there are multiple layers, and I would recommend, talking to me. You can reach me through email or definitely speaking with a lawyer, especially when it comes to liability.
Oh, thank you so much for shedding light on that important information. And lastly, Andrew, what are your top three bookkeeping tips for small business owners?
Um, One is definitely keep, your personal finances and your business finances completely separate. That's number one. I always tell clients to, have a separate business bank account and or credit card. Because really at the end of the year, or at the end of the period, especially if you need accounting software yet and you're still in those beginning stages, keep everything separate. Because at the end of the year, you can export those business transactions to Excel from online banking. And I would actually use that Excel file to create the income statement and balance sheet, to review the reports, and have a meaningful discussion about real data with the business owner. So yeah, number one, definitely keep business and personal transactions completely separate.
Okay,
So that's one.
I
Yeah, go
think
ahead.
I do have a question about that. So if if a business owner has more than one credit card, say they have a MasterCard, they have a Visa, they have an American Express, and they're personal credit cards, but they want to
Mhm.
use one of those personal credit cards strictly for the business, is that okay? Or do you advise that they
That
change that credit card into a business credit card?
there's no need to change the type of card, but if you have a personal credit card, that's fine. Just only use that one for business. It's just the mix that can create confusion. But yeah, it's perfectly fine to have two personal bank accounts or two personal credit cards, but just dedicate one for businesses. Yeah. And then the second thing I would say is, at the end of the day, don't get caught up in the bookkeeping, or the registration or the tracking of things, because that can be very time consuming and only slow you down. I would say really stay or stick with what you got into business for,
Mm.
whether it be, candle making pizza, or whatever. Do what you do best, focus on that, and then when the professional, do the rest. Because trying to do everything at the same time will only slow you down. And then lastly, at the end of the day, the only thing that matters is what the reports say and how you can prove it to a potential investor, the bank, a partner, or CRA. Yeah, at the end of the day, the only thing that matters is what the reports say, because that is what you're going to share. That is what you, as a business owner, are going to use to make real decisions, to expand, to contract, maybe change how you operate. It's the data that you're using to make good decisions. So at the end of the day, it's the reports, the data that matter.
Well, Andrew, thank you so much. Your advice that you're sharing right now is so beneficial to so many business owners, not just here in Ontario, but across the entire country. And I want to thank you so much for appearing on the Pure Passion Biz Podcast. To all of you who are watching, you'll be able to connect with Andrew by using the contact information that is listed in the description box. And thank you again for being a guest today, Andrew. Thank you. You're most welcome. And to all of you who are watching, thank you so much and have a wonderful day.